So imagine you're looking at a company, right? And their stock is just cratering because Wall Street is entirely convinced that, well, that artificial intelligence is going to put them completely out of business.
Right. The narrative is totally set. The obituary is practically already written at that point.
Exactly. But then, out of nowhere, over the course of just like 5 days, the stock violently surges almost 16%.
Which is a massive move.
Yeah, it's huge. So the question is, what changed? Well, investors suddenly realized that AI wasn't the Grim Reaper coming for this company. It was actually, it was their secret weapon.
Yeah, it's honestly one of the most fascinating pendulum swings in recent market history. I mean,
Yeah.
we are looking at a situation where the initial panic surrounding AI created this just massive blind spot.
Oh, for sure.
The market saw new technology and immediately assumed, cannibalization. They didn't stop to understand how that technology actually integrates into these massive, complex corporate systems.
And that is exactly what we are tearing into today for this deep dive. We're looking at a pretty comprehensive financial report on ServiceNow.
Which is an absolute giant in the enterprise software space.
Right. And if you've been watching the tech sector, you probably saw this stock wallowing in the red earlier this year. I mean, it was down nearly 28% year to date at its lowest point.
Yeah, everyone thought traditional workflow software was just dead.
Because the logic was, hey, if an AI can write code and organize data and answer HR questions, why on earth would a Fortune 500 company pay millions of dollars for a legacy software platform to, I don't know, route internal tickets?
And that was the bare thesis in a nutshell.
Right.
Why pay for a digital traffic cop when the AI can just drive the cars itself?
Exactly.
But, to understand why that 15.8% surge happened, why the narrative flipped so violently, we really have to look at what the company actually reported.
Right. So I'm looking at this Q2 2026 report, and they just seemingly blindsided Wall Street's pessimistic expectations. But you have the raw data in front of you, right? Like, how much did they actually beat these estimates by?
Oh, it was a substantial beat across the board.
Yeah.
I mean, they posted a 24% jump in revenue.
Wow.
Yeah, bringing them to nearly $4 billion just for the quarter alone.
Just for one quarter.
Right. And the consensus estimate was sitting around $3.9 billion, so they cleared that easily. But more importantly, their trailing 12-month revenue growth is holding really steady at 22.19%.
Okay, growing at 22% when you're already making billions of dollars a quarter, that is not a trivial thing.
Not at all.
That takes massive sustained demand. But so here is the million-dollar question, right? If AI is supposed to be this existential threat that's replacing the need for workflow management, how are they growing revenue this aggressively?
Well, the answer lies in a really critical distinction that the market just completely missed early on. It's the difference between generative AI and agentic AI.
Okay, break that down for us, because I think a lot of people, just lump all AI into one big bucket.
Exactly, and that's exactly where the mispricing happened. So generative AI is what we are all used to.
You're right, like ChatGPT.
Right. You sit at your computer, you type a prompt into a chatbot, and it generates a poem or a block of code or, an email draft. It requires a human to initiate the action and a human to actually use the output.
Okay, got it.
But agentic AI is an entirely different beast. It acts as an autonomous agent.
Autonomous meaning it just does things on its own.
Exactly.
Yeah.
It executes multi-step, really complex tasks across different software systems without any human intervention at all.
Okay, so let's make this concrete for everyone listening. Give me an example of how that actually looks inside, say, a massive corporation.
Sure. Think about employee onboarding. Historically, a human IT worker gets a ticket saying, new hire starting Monday.
The classic IT ticket.
Right. And that human manually logs into the provisioning software, they create an email address, they set up the payroll, ping the hiring manager for approval, and then finally they close the ticket.
And the fear was that AI would just replace that specific IT worker.
Yes, exactly.
Yeah.
But here's what actually happens with agentic AI. The AI reads the initial request, sure, but to do all those specific tasks, it has to constantly communicate with the payroll system, the security system, the email servers.
Oh, I see.
Yeah, it's sending hundreds of micro requests, checking statuses, verifying permissions. It is constantly talking to other machines.
Right.
And all of that machine-to-machine communication, those agentic use cases, are driving 5 to 12 times the standard workflow volume directly through ServiceNow's platform.
Okay, wait, so instead of replacing the highway system entirely, AI is basically just putting way more traffic on it.
Not just more traffic. Think of AI as a newly invented fleet of millions of automated, super high-speed delivery trucks.
Okay.
They don't need to sleep. They don't take breaks. They're just zooming back and forth, executing tasks 234/7.
And suddenly, they are causing a massive 10x traffic jam on the corporate digital highways, and ServiceNow just happens to own all the toll booths.
That is the perfect way to visualize it, honestly.
Yeah.
ServiceNow is the infrastructure. They route the requests, they verify the security, and they log all the actions.
So more agents equals more money.
Exactly. More AI agents mean exponentially more traffic, more complex routing requirements, and ultimately, a much heavier reliance on that foundational infrastructure.
That makes so much sense.
And you can really see this playing out in the company's forward guidance.
Mm.
Management isn't just surviving here, they just raised their full-year guidance.
Wait, they raised it?
Yeah, they are now calling for subscription revenue to cross $15.8 billion.
Okay, but did they specify how much of that is directly tied to AI? Because let's be real, it is very easy for a tech CEO to just say AI on an earnings call to get a quick stock bump. Are companies actually signing checks for this specific tech?
They really are.
Yeah.
The company is expecting AI-specific commitments to hit $1.5 billion this year.
Wait.
Yeah, that is a 50% jump from their prior guidance just a few months ago.
That's a massive acceleration.
It is.
Yeah.
And if you look at their remaining performance obligations, which is basically contracted revenue that just hasn't been recognized on the books yet, that grew 21% to $13.2 billion.
So it's locked in.
Exactly.
Yeah.
This isn't just theoretical demand. These are signed multi-year contracts locking in this revenue.
Okay, building a massive AI toll booth sounds incredibly lucrative. But if I'm, say, a venture capitalist looking at this space and I see 5 to 12 times more traffic and enterprise workflows, my immediate thought is disruption.
Sure.
Like, why wouldn't I just fund a shiny new AI-native startup to build a better toll booth and steal all that new volume from the legacy player?
Because that fundamentally underestimates the mechanics of an enterprise mode. ServiceNow operates inside what we call a fortress mode.
A fortress moat. I
Yeah.
like that.
Yeah, to understand why a startup can't just swoop in and steal their lunch, you have to look at how ServiceNow is ingrained in its customer systems. We are talking about massive Fortune 500 companies, global banks, sprawling healthcare networks.
Right. These aren't small mom-and-pop shops.
Exactly. Their workflows aren't just, sending simple emails. They are tied into hyper-specific custom business rules, really intense security protocols, and super strict regulatory audit trails.
Okay, let's pull on that thread for a second. The audit trails. If you're a major bank, why does that make switching your software nearly impossible?
But think about what happens if federal regulators walk into a global bank and ask why a multi-million-dollar transfer was approved last year.
They need to prove who did it.
Right. The bank uses ServiceNow to show the exact timestamp, the employee ID, the risk assessment, and the entire chain of approvals.
Okay.
If you unplug ServiceNow on a Friday and then try to plug a shiny new AI startup in on Monday, that historical trail completely breaks. You lose the mapping.
Oh, wow. So you'd literally be flying blind with federal regulators.
Exactly. The switching costs are astronomically high. Extracting it would be like trying to take the foundation out of a skyscraper while people are still working on the top floor.
So it's not just that the software is good, it's that the actual pain of replacing it is financially and legally terrifying for a chief information officer.
Exactly. It completely protects their market share against both point solution competitors and those new AI native disruptors. The infrastructure is just too deeply embedded.
Okay, but if you're looking at the stock chart right now, you're probably seeing one glaring flashing red light. This report notes that the stock's trailing PE ratio, so the price to earnings ratio, is sitting at 68.5.
Yeah, it's high.
I mean, even with the moat, even with the 5x volume growth, a PE pushing 69 means investors are paying a massive premium for future growth. Isn't that priced for absolute perfection? Like, if they stumble even slightly, doesn't that multiple just collapse?
It is a highly demanding valuation. There's no denying that. A PE of 68.5 leaves very little room for error. But to understand why the market tolerates it, you really have to look at the underlying financial engine defending that valuation.
Okay, walk me through that.
First, we are looking at a company with a market cap of over $114 billion. And their gross margin, it's sitting at an astounding 74.79%.
Nearly 75% gross margins. That really highlights the absolute beauty of enterprise software, right? Once the code is written, selling another copy or routing another AI agent costs them virtually nothing.
Precisely. The incremental cost of revenue is tiny. But the report highlights another move that really proves their financial health, and it's a bit counterintuitive, honestly.
What did they do?
They just accessed the debt markets with a $4 billion five-part senior unsecured note sale. This includes notes maturing in 2028 and extending all the way out to 2056.
Wait, hold on. Raising $4 billion in debt. Because for a lot of people listening, taking on massive debt sounds like a huge red flag.
Right, it sounds risky.
Yeah, it sounds like they need cash just to keep the lights on. Why is taking on $4 billion in debt a good thing here?
Well, in corporate finance, especially at this kind of massive scale, it's actually a massive flex. The key is how they are raising it. This debt was rated A2 by Moody's and A by S&P Global Ratings.
Okay, and an A rating in today's economic climate means what exactly?
It means the credit agencies view their cash flow as incredibly stable and low risk. They aren't raising debt because they are desperate. They are raising it because the cost of that capital is incredibly cheap for them.
Ah, I see.
Yeah, and they can use it to aggressively fund their growth initiatives. They can build out this massive AI infrastructure, acquire smaller companies, and lock down market share while their competitors are struggling to secure funding at reasonable rates.
So the capital itself basically becomes both a weapon and a shield. Okay, so the fundamentals are robust, the moat is deep, the margins are incredible, and they have the capital to kind of bully their way through an expansion. But, fundamentals are only half the story. Market sentiment is the engine that actually moves the stock price day to day. How is Wall Street digesting all of this reality?
Let's look at the technical setup first. Despite this aggressive recent rally to around $116 a share, the stock is still significantly below its peak.
Really?
Yeah, it's actually 42.1% away from its 52-week high of $201.15. It bottomed out near $81 not too long ago.
Wow. So even after a violent 16% surge, they still have a massive runway just to get back to where they were a year ago. The market hasn't fully priced in a total recovery yet.
Exactly. The report explicitly notes there is a, quote, substantial runway for a recovery rally. But if you want to understand market sentiment, you have to look at the insiders, the executives actually running the company.
Right. Follow the smart money.
Exactly. And the report highlights a data point here that looks completely contradictory at first glance.
Let me guess. They are selling.
They are. Over the last 90 days, insiders have sold a net 39,042 shares.
Wait, hold on. You're telling me the company is experiencing a 10x surge in workflow volume, they have an impenetrable moat, they're actively raising guidance, and the insiders running the show just dumped 39,000 shares.
Yep.
That sounds like a massive red flag. But the report says their sentiment score is a perfect 100. That sounds like financial gymnastics. How does that math actually work?
It does sound contradictory, right?
Okay.
But the key here is the MSPR, the money-weighted sentiment polling ratio. This metric separates the raw number of shares from the actual dollar value of the transactions.
Okay, walk me through the mechanism of how a big sell-off translates to a perfect 100 sentiment score.
Sure. Imagine you have a few executives who have been at the company for years. Their compensation is heavily stock-based, right?
Right.
So they sell thousands of lower-value stock options just to cover their tax liabilities, or maybe to buy a house. That increases the shares sold count dramatically.
Okay, I'm following.
But simultaneously, a few key insiders, maybe the CEO or the board members, are going into the open market and spending massive amounts of real personal dollars buying stock at the current market price.
Oh, so a lot of lower-level executives are selling a bunch of cheap shares for taxes, but the heavy hitters are basically backing up the truck and buying expensive shares with real cash.
Exactly. The sheer dollar value of the incoming capital heavily outweighs the monetary value of the shares being sold. The MSPR hits 100 because it tracks the weight of the money.
Got it.
It implies aggressive cluster buying by the people who actually know exactly what's happening inside the building.
Okay, that makes total sense when you break down the mechanism. It's not about the share count at all. It's about where the actual wealth is moving. And speaking of wealth moving, the broader analyst community is definitely catching the scent here.
They really are. The report notes that 90% of Wall Street analysts currently rate the stock as a buy.
90%.
Yeah, and the median target calls for 18% upside from here, and the highest target on the street is sitting all the way up at $236 a share.
Which is higher than its 52-week peak. But, analysts don't just upgrade targets based on past performance. They need a speculative catalyst. What is the rumor driving that $236 price target?
The rumor mill is incredibly powerful in enterprise tech right now. There is widespread chatter and this is unconfirmed by the company, to be clear, regarding a deepening of partnerships, specifically in the agentic AI space.
Okay, who are they talking to?
The loudest whispers are about a potential major expansion with Anthropic's Claude.
Oh, wow. For anyone not obsessively following the AI model wars, Anthropic is one of the absolute heavyweights. I mean, they build foundation models that directly compete with OpenAI's ChatGPT.
Exactly.
And Claude is known for being particularly strong at complex reasoning and coding. So if ServiceNow integrates deeply with Claude, what is the end game there?
Well, the goal, according to the report's analysis of the rumors anyway, is to make ServiceNow the absolute undisputed orchestration layer for agentic AI.
Okay.
You have Claude providing the raw intelligence and the reasoning capabilities, and then you have ServiceNow providing the secure, audited, enterprise-grade highway for that intelligence to actually execute tasks inside a Fortune 500 company.
It's basically the ultimate marriage of brains and infrastructure.
Exactly.
Okay, so we have painted a very rosy picture here. The highway metaphor, the massive 75% margins, the insider cluster buying, the Anthropic rumors. But the report scores this as an 8 out of 10 bullish setup,
Right.
which means there is 20% left over. We have to ground this in reality. What comprises that 20%? What is the bear case that could bring this all crashing down?
The bear case is entirely rooted in macroeconomics and real-world risks. We discussed that high trailing PE of 68.5. We have to talk about the environment that multiple actually lives in. High growth software multiples absolutely hate high interest rates.
Walk us through the mechanics of that. Why does a software company with great margins care if the Federal Reserve raises rates by 0.25%?
Because of how Wall Street values future cash flows. When you buy a stock with a PE of 68, you are paying for the profits they're going to make 5, maybe 10 years from now.
Right.
When interest rates are low, those future profits look great. But when interest rates are high, an investor can get a guaranteed 5% return just buying government bonds totally risk-free.
Oh, so the opportunity cost shifts.
Exactly. So the present value of those distant software profits gets discounted heavily. High rates make expensive stocks look dramatically more expensive.
And the interest rate picture isn't exactly a guaranteed smooth glide path to zero right now, is it?
Not at all. The report cites polymarket odds that recently hit 67% for 0 Fed rate cuts in 2026.
None at all.
Right. Now, a recent drop in Treasury yields definitely helped improve the market's appetite for enterprise software over the last few weeks, which certainly contributed to this rally. But it remains a very volatile tightrope.
So if things flip back.
Yeah, if inflation ticks back up or yields spike again, that 68 PE multiple could get compressed violently, regardless of how good the AI toll booth is actually running.
There's also a very specific, tangible risk highlighted in the report that has nothing to do with software or the Fed. It's geopolitical turmoil.
Yes, specifically the ongoing situation in the Middle East.
Right, and we often think of cloud computing as existing in a vacuum, totally immune to geography. But the report states that geopolitical turmoil actively pushed back multiple sizable government contracts for ServiceNow.
It did, and it had a very measurable impact. The delay of those federal contracts actually shaved 75 basis points off their Q1 subscription revenue growth.
Okay, I have to stop you there. We hear basis points thrown around on financial networks all the time. For someone not staring at a balance sheet all day, what does a 75 basis point hit actually mean in real dollars?
A basis point is 0.01%. So
Yeah.
75 basis points is 0.75%.
Doesn't sound like much.
It doesn't, but when you are talking about billions of dollars in expected subscription revenue, 0.75% translates to tens of millions of dollars in highly anticipated cash flow that simply didn't arrive on schedule.
That is a massive chunk of change to just evaporate because of a news cycle overseas.
It raises a really critical point about dependencies. When you are a global enterprise software company, your success is tethered to global stability. Government contracts are massive, lucrative, multi-year deals, but they're also highly sensitive to geopolitical shifts.
Because their priorities change overnight.
Exactly. If a government is dealing with a sudden international crisis, upgrading their internal IT workflow orchestration suddenly drops to the absolute bottom of the priority list. Budgets freeze, signatures get delayed.
So we have severe macro pressures with interest rates potentially staying higher for longer, and we have geopolitical ripples actively delaying tens of millions in contracts. Looking ahead, what is the proving ground? What is the next major hurdle ServiceNow has to clear to prove to the market that the 80% bull case actually outweighs that 20% bear case?
The upcoming Q3 earnings report is going to be a major test. This recent 16% stock rally implies that the market is finally starting to price in the success of this AI transition. They survived the Grim Reaper narrative,
Right.
but now they actually have to deliver on the hype. Specifically, investors are laser-focused on the continued rollout of what ServiceNow calls the AI Control Tower.
That's their new agentic AI orchestration platform, right? Like the actual toll booth software itself.
Exactly. The narrative is totally established now. Agentic use cases require 5 to 12 times the workflow volume. The theory is fundamentally sound, and the early guidance reflects it.
Okay.
But in Q3, the company has to prove that this massive influx of machine-to-machine volume is actually translating into hard, recurring revenue. They have to prove to Wall Street that the toll booths are actually collecting cash on every single one of those automated delivery trucks, not just sitting there watching the traffic go by.
Because if the volume goes up 10x, but they can't monetize it, then all they have is a significantly more expensive server bill.
Precisely. They have to demonstrate pricing power in the era of AI.
So if we synthesize this whole journey we've been on today, we started with a stock that was down 28% because the market was basically terrified. But this report paints a picture of a company that was severely mispriced by investors who mistook an evolutionary catalyst for an existential threat.
Right.
They saw the AI Grim Reaper, but the internal mechanisms of enterprise software prove it's actually a massive tailwind.
It is a textbook case of the market misunderstanding the practical application of a new disruptive technology.
Yeah.
And I think there is a broader takeaway here. Regardless of whether you are actively managing a portfolio or if you're simply fascinated by the mechanics of the tech industry.
Yeah.
ServiceNow right now is a masterclass in corporate adaptation. It proves that legacy tech companies don't just have to roll over and die when disruption arrives. If a company has a deeply entrenched moat, the capital to sustain pivot, and the strategic foresight to build the infrastructure, they can transition into the foundational layer of that very disruption.
They basically become the picks and shovels of the AI gold rush. But, you know, that actually leads me to one final mind-expanding thought for us to leave on today. Something that wasn't explicitly spelled out in the financial models we reviewed, but is the logical next step of this entire transition.
Oh yeah, what's that?
Well, we established that agentic AI is quietly multiplying automated machine-to-machine software tasks by 5 to 12 times behind the scenes. This is an invisible, exponential explosion of data and workflows running continuously.
Right, a massive unseen traffic jam of APIs pulling each other every single second of the day.
Exactly. But virtual software still has to live on physical hardware. If the virtual workflow volume inside Fortune 500 companies is suddenly 10xing because agents are talking to agents, what does that mean for our physical infrastructure?
Oh, wow.
The server racks, the cooling systems, the energy grids, the physical data centers that now have to process all of those millions of automated microactions. If software companies like ServiceNow are successfully absorbing the virtual shockwave of AI, is a massive physical bottleneck like an energy and infrastructure crisis, the real next big tech threat hiding in plain sight.
That is a terrifying thought, but very plausible.
It's definitely something for all of you to mull over as the AI revolution quietly speeds up behind the scenes. Thanks for joining us on this deep dive.